Good morning, everyone, and welcome to our webinar on the Goods and Services Tax. My name is Tara Panjwani, and I'll be your moderator today. Just to give a little brief introduction before we kick off, on the 3rd of August, the Indian government passed the long-awaited GST bill, possibly the most revolutionary reform since independence. As you are all aware, GST is a comprehensive indirect tax that will replace the current multi-layered tax system and create a uniform tax structure across the country. It is expected to be a real game changer for the Indian economy and a decisive step towards creating a common national market. Our speakers today are highly qualified tax experts who will discuss the implementation of GST and the implications to UK businesses. They will also touch upon the challenges that we can expect to encounter in the lead up to it being enacted. So without further ado, I will continue. But before we begin, I would like to familiarize you with the toolbox on the right-hand side of your screens. Just to let you know, everyone will be on mute during the course of the webinar, but if you do have a question, please type it into the little bracket on your toolbox in the please type your question here section to send this to me, and I will take it up during our Q&A session at the end. I'm just going to do a brief introduction of our expert speakers today. So we have 1 minute, just pulling it up. Gautam Khattar, who is a partner at Tax and Regulatory Services, and John Shuka, who is the engagement lead at PwC. Gautam is lead at PwC in December 2002 and has got extensive experience in custody and VAT consulting, including optimization, conducting diagnostic reviews, advisory, VAT, and tax assessment. He also has, sorry, just 1 minute, a few things that I'm reading out. He interacts frequently with the Central Board of Excise and Customs and the tax authorities, and therefore I think his insights will be really useful as to what's happening on ground in terms of the planning of GST. Just going to open up John's bio 1 minute. John Shuka, the engagement lead with PwC, is an indirect tax leader in PwC's UK tax practice with more than 25 years of experience of dealing with international direct and indirect tax. He's worked for large global MNCs, including Europe, US, and Asian multinationals. His clients include a number of FTSE 100 companies and international groups advising on strategy, system, supply chain management, and compliance. So I think now we will hand it over to our expert speakers to take over the presentation. Thank you very much.
Thank you, Tara. It's John Shuka speaking here. I just want to introduce Gautam very briefly and to explain partly why I'm here. First of all, my experience, as you say, is responsibility for international markets, including India, and my experience with GST started with the very first GST, which was invoked in New Zealand from the 1st of October 1988, and I've seen the others in various other countries since. Very exciting times for VAT and GST at the moment, with the Indian announcement and also the introduction of VAT in the Gulf cooperation countries, and Brexit itself will bring some new challenges in the indirect tax area. So without further ado, I will hand over to Gautam, who will take you through the presentation on what is expected to happen with India's new GST. Thank you.
Thank you, John, and thank you, Tara, for the introductions. Without wasting time, I will move in to the slide deck. There are 3 sections today for discussion. One, I would briefly give you an introduction on the GST status and the framework, and then we will get into some of the key impact areas for the business. And we will conclude on what are the next steps. Before moving ahead, just to give you a sense on the timelines, which is the next slide, Today, as Tara indicated, in the month of August, the GST bill, while she mentioned, it was the Constitution Amendment Bill which was passed by the Indian Parliament. This, no doubt, was a big achievement, a big milestone which we crossed. And most importantly, because the Constitution of India had to be amended so as to align the parts between the center and state for introduction of GST. Therefore, this Constitution Amendment Bill, which took place in August, was thereafter ratified with all the states, majority of the states, and has now been awarded the President assent. So, as we stand today, the political hurdle towards GST, as India has been seeing for the past decade, is now over. Now we are in a phase 2, which is more technical, more coming out with the GST legislation, the rates and laws. So starting today till April, we will be now discussing more on the technical side of GST. In that perspective, GST Council has been set up, and now GST Council in the month of October, November would come out with the rates and rules around GST, which will go through the Parliament for approval again in December. The final phase of GST would be around January to March of next year, when you will see the fine print of the regulations coming out. Yes, it's a very tight timeline if April has to become a reality, and therefore even looking at companies to have their IT systems ready and cut invoices by April, it is going to be a challenging task if only the rules and the final printout comes only in Jan and March. Therefore, somewhere there is a sense industries are pushing and talking to the government of India to see whether April might be pushed towards July. So while the central government is targeting April as a timeline, there is a possibility that as we go along, the timeline could be pushed by a few months, say to July or in October of 17. Having said that, that will just give us enough room to get the IT systems in place right in time. Moving ahead to the next slide, and giving you a framework of GST legislation in India, which most of you would know. Since India is a federal structure, the GST in India is going to be a dual GST. It would have a central GST and a state GST component to it. So any transaction within a state would be subject to a center and state GST. In case there is a supply from one state to the other, it would be integrated GST, which is IGST, and which is nothing but a sum total of center and state GST, which are denoted here by CGST and SGST. The rates, much debated topic in India at this point in time. There was a report by the Chief Economic Advisor which had recommended rates, a standard rate of 18-19% on majority of the goods. There was a concessional slab of 12%, which would be for select essential items, and a demerit rate of 40%, which would be there, say, for luxury cars and beverages, aerated drinks rather. So these are rates which have been set forth by one of the committees. The GST Council, which has now been set up, is tasked with coming out with the final rates. Obviously, they will look at these recommendations which have been made by the committee and proceed. A point on rates is today in the Indian legislation, there are multiple taxes, excise and VAT, excise on manufacture and VAT on goods. Effectively, for most of the industry, these rates, effective rate pans out close to 25-26%. So there has been a big debate whether this 18% rate would be substantial or it should be on a higher side. So that's a debate as we speak which goes on, and the Council will be tasked of looking at the various recommendations from the economic advisor, seek inputs from industry, and come out with the appropriate rate. Moving ahead to what is changing under GST. Largely, today the Indian tax regime is more on origin based. The tax collected is by the originating state where the transaction starts from, whereas GST is going to be on the consumption base. And because of the origin based taxation, there are inherent tax costs in the supply chain, since the recipient state does not give credit of taxes which are paid in the originating state. This concept is going to undergo a change, and the GST which will come in would be more on consumption based, and therefore the entire supply chain would be entitled to avail credit of GST, and therefore there would be no tax cost, which again throws up options around supply chain to have a smoother supply chain, do not have various warehousing based on tax nuances, but on business rationale. Also, the key principle of taxation, which today in India differs. For a local state level taxes, it is sale of goods, and at central level, when you manufacture goods, you pay excise duty. These different incidents of taxes, namely manufacture and sale, are going to go away, and the concept which will be there is supply of goods and services with or without a consideration would be subject to GST. This again will throw up various nuances. As we go along, we'll talk about it, but it moves away drastically from the current concept of sale of goods, manufacture of goods, to supply of goods and services with or without a consideration. Also, the service sector today, which is subject to a service tax, which is a central levy, would now be exposed to state level taxes, since the states would also have power to levy GST on services. So again, a big change for the service sector, some of the impact areas which we are going to talk about in subsequent slides. But upfront, obviously moving away from a central and a centralized concept to a regime where there will be center and state dual control is going to open up the service industry to various audits and dealing with different tax authorities. Moving ahead, these are some of the important aspects which companies should bear in mind as you look at GST, since it is no longer a tax area, but it is impacting the entire business operations. It is impacting the financials of a company. It is going to bring to table some of the various values in terms of supply chain, in terms of competitiveness to the company. It would also throw up challenges largely on the IT side, given the limited time frame of introduction of GST and how companies can be IT compliant. Moving ahead, the key factors which is driving business today, one of the key factors is the pricing. This is going to have impacts from multiple corners. Simply looking at change in tax rate, procurements, transition, these are the factors which is going to impact pricing of any products in India or services. Business would need to look at whether they pass on these benefits or keep it with them. Largely, these decisions would be driven by competitive pricing. Just to take quickly a few examples. The first one being the pricing impact itself. As I indicated, the effective tax rate for a manufacturing entity could be anywhere upwards 28-29%. GST likely to reduce to 18, even if you stretch it to 22%. There is a lower effective tax rate which is going to come in. Therefore, no doubt, manufacturing sector is going to or is required to look at the pricing impact just purely from a rate perspective. If you look at procurements, today if companies buy from one state, if company is in state A, it buys goods from state B, the taxes which it pays are a cost since the taxes are origin based. So the inherent tax cost when you are buying goods from one state to the other state or moving goods from one state to the other, that tax cost is largely going to go away. Therefore, bringing in the opportunity of saving on procurements. On the same side, services, which today is taxed at 15% and there are certain concessional services, the tax on services would go to 18%. So it would be interesting to see the overall impact on procurement of goods and services and how does this impact the overall pricing of a company and the financials. The other interesting point on procurement is vendor management. The compliance system as it envisages under GST would largely depend how compliant your vendor is, how timely your vendor provides and submits all its returns. In the event there are defaults on compliances by your vendors in undertaking due return filing, we as US companies would be impacted and you would not be entitled to take credits. Therefore, the onus is being put on larger MNCs and companies to ensure that their vendors are compliant, else they will lose out on credits. Therefore, a key element would be of vendor management. Moving ahead to some more examples which is on supply chain and marketing. From a supply chain perspective, today when we transfer goods from one state to the other, there is no tax as there is no sale of goods. However, under GST, movement of goods from one state to the other, since it is a supply without a consideration within the same legal entity, would still be subject to a GST. However, the recipient warehouse or a depot can take credit of this GST. Therefore, it is going to be a working capital issue. Companies can take credit, and this gives an opportunity for companies to look at the impact on working capitals and see whether they need such a long supply chain if they have. Another interesting point is going to be on marketing and sales costs. Any free supplies are subject to GST. Therefore, marketing buy one and the second one free would definitely intake that the free item is valued as per the valuation principles which are prescribed under GST and appropriate GST is charged. Else, companies would need to think around the marketing policies to come out with bundled pricing or a discounted price and move away from the concept of free. Again, this would require a lot of mindset around the marketing and how the customer is going to react to these. Moving to the last example on transition stock, relevant for a lot of traders, companies having finished goods lying at their depot or their or at their dealers' premises. If there is an excise tax which is embedded cost in these products today, would not be allowed to be carried forward as a credit under GST. So ineligible credit cost which is embedded in finished products would not be allowed to move ahead. Therefore, even at dealers, there is a probability that dealers could come back to the manufacturers to make good the loss which they are going to suffer, because the tax rate for certain products may increase, whereas tax rate on certain products are decreasing. To that extent, it will not impact. But this is definitely a transition issue and therefore requiring inventory management as you go along. Coming back to the main slide, so these are some of the examples on pricing which I thought could be relevant for us to look at. Moving ahead to the next critical item of compliances under GST. While there would be a central state and IGST, each company in each state can have one GST registration, which will cover these three elements of GST. However, companies operating through multiple states would need to have multiple GST registrations, and typically in a month there would be a sales return, a purchase return, and a monthly return. So 3 returns in a month, followed by an annual return close to month of December at the end of the financial year. So 3 monthly returns plus an annual return, that is a must for each state. Depending on the number of states companies are going to operate, these would be multiplied with as many. So compliance is going to be a cumbersome thing to look at, because to ensure credits, you would need to also align yourself with the vendors. So one would be your compliance. Also take care and evaluate how your vendors are doing compliances, is something which the companies would need to look at. Also, since the GST since services would be subject to state GST, and there would be a state element of GST on goods and services, there would be a requirement that the companies would need to maintain a profit and loss account state by state. Therefore, you would need to maintain expenditure and income state by state in India, and therefore that level of compliances would be required, and therefore a need for the IT readiness, which is my subsequent slide. ERP systems, a lot of bigger ERP players are working on patches for the current ERPs, which would help companies interact between their systems and the government system where all the IT compliances would need to be. However, if there are customization which are done today on systems, those would need to be looked at separately. And if you're going to look at master data, configuration, role authorization, these are all 4 buckets which would undergo a drastic change. As an example, today in a master data, if you have a vendor A, you could have one code assigned to that vendor because they may have one service tax registration, which is a central levy, and therefore there is no multiple registrations required for a service provider. Under the GST regime, a service provider may need multiple state-by-state registrations, and therefore that master data for one entity would have multiple GST registration number based on its operations in different states. Therefore, the master data itself would need to have 10 or 15 codes for a particular vendor depending on the operations of that vendor in different states. Likewise, all these buckets undergo a change. As I mentioned, IT is critical and will be critical despite the fact that companies will get patches from the ERP service provider. Moving ahead, therefore, what should the organization do as a next step? I think it is an opportune time to set up core teams at entity level and also at the corporate level where you have the IT team working along. you need to engage with the ERP and relevant software vendors to see what is the level of development, what are the patches they are working at for India, and what is the coverage of that patch. In case your systems have different networks like a dealer management or a customer network which are localized, you would still need to look at this independent of the patches which the ERP or the relevant software vendor would release. Impact assessment, overall what you need to look at is looking at the probable impact which GST is having. You could do this impact analysis as of today on the business finance side, looking at how it is impacting your overall business and the financial profit and loss statement for the next year. We have a draft legislation in public domain that can form the guidance for undertaking this impact assessment. Likewise, on the IT side, you could look at a gap assessment, identifying gaps, what gaps are there, and looking at an effort estimation of overcoming that gap once the final legislation is out. So an impact assessment covering the systems, covering the processes, and the business side is something which definitely organizations can do now, because from today till November or maybe December, there is a time where you could look at a certain level of planning, and an application of mine can be done in a more qualitative manner. Starting this January, it will be more on an implementation side, and the efforts would be towards implementing, getting registrations, getting credits, planning on inventories, planning the system is up to speed so that we are ready for meeting the April timeline. So that's something which the companies can look at. And I would now take a pause and open up for any discussion which we would want to have. Thank you.
Gautam, thank you. That was very enlightening and answered quite a lot of the questions that were coming up during the presentation. Obviously, you mentioned that there are some big changes required to IT, and it sounds a lot like what we see with the European EU VAT system at the moment, some of the changes that are required, particularly with having individual registrations in individual states. In your experience, what are businesses doing? Are the patches that have been provided by IT vendors sufficient to deal with it, or are companies really having to build some quite complicated changes into their system themselves?
So, John, at presently, no ERP vendor has provided patches. We believe these patches would typically come around the month of January or later part of December, and not before that. If that is the timeline when the companies with the ERP are going to release these patches, and that too, as we understand, patches would allow an interface between the existing system to the government system to pull out reports in a particular format to help you compute tax. If that's the function of those patches, organizations today still need to look at the systems to see what customization they have done specifically for India. If they have something over and above the existing ERP, all those customizations would need to be updated in terms of the GST legislation. So effectively, companies are looking at undertaking a gap analysis and come out with a module to say these are the gaps which the current system has vis-a-vis the proposed GST, and this is the effort estimate which will require them to overcome these gaps once the final legislation is implemented, because you would want to revalidate this gap assessment once you have the final law in place. And a gap assessment, if the exercise takes you a month today and you have the final legislation, you could do it in a few weeks. You could update it and get into implementation. So you save on time.
Okay, Great, thank you. One further question that's come up, and this is an increasing question in a lot of other countries as well. What's the effect on online sales into India? So sales from the big internet businesses, for example, to the extent that they're permitted, will they all have to register in each state that they've got customers?
The two aspects to this, if you're talking about e-commerce sales, which are today Indian companies or larger companies having e-commerce set up, yes, there is a regulation around them. They would need to discharge taxes. However, the exact clarity in terms of companies' online sales, if there is an online sale of goods, the current regime where there are on import duties paid and import GST, that would be applicable, and therefore there is no proposition at this point that overseas company providing online sales or through net, they need to register in India. It's basically if there are services from overseas provided, the Indian recipient needs to self-declare and pay. Or if there are goods provided, it would be assessed on reverse charge by the Indian recipient if it's a corporate.
So if as an individual you buy services, for example, music recording or something like that, they would not have to register under the current proposals?
Yes, they don't need to register, and individuals also would not be subject to tax because that's a self-consumption. There is an exemption for that.
Okay. Good. Thank you.
Thank you very much, dear Gautam and John. That was really informative and insightful, and it's clear that the changeover to GST seems like a huge task and requires a lot of careful thinking through. I appreciate the questions John put forward, and I have several questions lined up actually for you all, so get ready. I'm going to take a few questions from our speakers, and then I have a few that I would like to ask. The first question from one of our attendees is that there is a talk that the GST just now would subsume the SPC, the KK cess, and infra-cess, and unless the GST Council recommends otherwise, these would continue in the GST era as well. And the attendee is asking what your thoughts are on this, whether that would be the case.
So, on day one or year one of GST implementation, it is likely that there would be all these cess would no longer be there because the cess will be subsumed under the GST, which is going to be levied. Having said that, the Constitution gives the central government the power to levy cesses. So maybe as you see, as the government looks at its revenue collection 2 years or 1 year down the lane from GST, they may want to relook at introducing a cess, but my take is on day one, the cess would no longer be there, but they could come in probably 2 or 3 years down the lane.
Okay, that's good to know. As long as we don't go back to the current system where there are so many different cesses and taxes. But let's see. Yeah. So the next question is that yesterday apparently there was a news article that only 60% of the software part of GSTN is complete. The hardware hasn't yet been imported, after which it has to be installed and networked. In this scenario, what is the possibility of GST being implemented in April 2017? And I think you answered that by saying that it might be pushed back to July 2017. So I think that has actually answered the question. I'll go on to the next question. Would there be uniformity in the state GST rates, or would it differ from state to state, taking us back to the VAT era effectively?
So I guess my answer is also similar to the cess one, because these are two areas. One, the central government has retained the power to levy cesses, and second, the states have the power to tweak the state GST element. Now, there is a discussion that this tweaking should be limited in a band, say 1 or 2% point. So, as an example, if the GST rate is 18, it would be 9 center, 9 state. So the state may increase the 9 to say a 10 or 11, taking the effective rate to 20%. So there is a possibility, while the states have the power, there is a possibility states look at it, but it would be in a small band. It would not be like the current situation where a state charges 5 and the other state charges 12.5. It could be that it's 18 in state A and 20 in state B. That possibility could be there. Again, I would believe this possibility should not be there on day one, but come in another 2 or 3 years down the lane once GST is implemented. But to say these are the two exceptions on state rates and cess. Beyond this, the framework, the provisions should be more or less consistent across states. The role of GST Council is to ensure that these rates and the legislation is consistent. However, political scenario at times takes the better of tax, and therefore, in which case states may be in a situation to push for slight tweaking of the state GST rate.
Okay, thank you. I'm going to ask one more question from another attendee, and then I have a question of my own, Gautam. The question from the attendee is, what about assessments pending before the implementation of GST? I'm not sure if, do you understand that?
Yeah, I understand that. So the states are looking at increasing the pace of concluding the assessments. Some of the states have been really fast on this because they want to close most of the assessments. To the extent assessments are not closed, they would be governed by the existing provisions, and they may be taken up as and when they are taken up under the GST era, they would be governed by the current provisions. What this requires as an action point is that we would still under GST era need to ensure that we have in our systems enough material which is for the current regime so that we are prepared as and when those assessments are taken up under GST regime.
Right. Thank you. So my question actually on behalf of a lot of our members is, what is the likelihood of alcohol coming under GST? Is there any talk amongst the councils and the planning committees that there is a possibility that that will happen? I mean, this demerit rate that you mentioned, does that apply to alcohol?
So I would say there is no possibility at this stage, and two reasons for that. So one is, the Constitution of India has now been amended. That clearly says that alcohol is out of GST. And now if alcohol has to come in, there has to be again a going back and amendment to that Constitution. So politically, a government going back and saying now they want alcohol under GST and therefore require an amendment in the Constitution, I think the opposition would really have a field day on this. So that is one more of a political reason why I believe it's not going to happen as one. Second, alcohol today, the tax is driven by states. States charge state excise duty on alcohol, which is way above 100%. The demerit rate, which I spoke about, was 40%. So the states are not likely to give away their revenue collection from alcohol, which is above 100%. So two reasons why I believe it is not going to happen at this stage, that alcohol is going to be coming under GST.
Okay, that's good to know. It's not great to hear, but it's good to know. and that helps us. So I can actually inform our alcohol member companies about that, companies like Diageo, etc. Another question for John. Actually, I read from your bio that you were instrumental in the development of GST in New Zealand. I was just wondering, was the process quite similar, or is the Indian system much more complicated, John? I hope that.
The Indian system is undoubtedly more complicated. When it was introduced in New Zealand, it was introduced at a rate of 10%, which was nice and easy to calculate, and you've only got one country. The other thing that they did when they introduced the GST was they dropped the income tax rate by more than 10%, so that sugared the pill of introducing GST. So it was quite different, but it was the first GST. My view is that what we're seeing with the Indian system is that the closest other GST system is the Canadian one, which was probably next after New Zealand, before South Africa and Singapore, if I remember rightly. And the EU VAT system in many respects resembles the interstate system that you've got under the Indian GST proposals.
Right. Okay. Fine. Thank you. That's good to know. Maybe there are lessons to learn from both. And who knows, hopefully they will in good time. That brings us to the end of our session. If there are more questions, we will email them to you. I just wanted to say thank you very much for your time and for giving this excellent presentation and all your good questions. I hope this webinar was interesting and valuable to you. Attendees, if you have any feedback or comments about today's session or a session that you want to see us in the future, please feel free to get in touch with us. Thank you very much for joining us, and thank you to our expert speakers. That was great.
Thank you.
Thank you.